Global debt markets are at an inflection point as central banks weigh further easing, inflation trends stabilize, and foreign flows react to shifting yield dynamics. What this means for the fixed income investors in the month of December. To understand this, we have with us Mr. Abhishek Bisen, Head Fixed Income at Kotak Mahindra Asset Management Company Limited. Welcome to the show, sir.
Hi.
So we know that the Fed maintained a cautious stance in November after the earlier rate cuts, right? How do you see this influencing the global capital flows into the Indian debt markets in December?
Okay, so this entire phenomena can be very classically defined by the term called VUCA, which is volatile, uncertain, ambiguous, and complex. So situation is pretty uncertain and volatile. However, as Fed is also pretty cautious and data dependent, it is creating uncertainty, and which is what has made people cautious and conservative. So as data unfolds, market is expecting the Fed to ease rates further, and that is going to ease the situation in terms of capital flows as well. Having said that, we have seen bond flows coming into our country, and there is possibility of Bloomberg Index inclusion of Indian government bonds, which is likely to attract more fixed income flows into the bond market.
So, with the bond yields at 6.52 to 6.55% in late November, where do you see the trend going in December, especially with RBI's possible rate cut and easing the liquidity also?
See, so given 10-year bond yield is trading at 6.52-55 and repo rate at 5.5%, it's a clear 100 basis point plus spread over repo, which is not discounting any kind of rate easing measure. However, market is expecting that there is a possibility of a 25 basis point rate cut in December, which is likely to trend lower in terms of bond yield as well. And at the same time, there is a possibility that RBI may take some liquidity measures in terms of announcing some OMOs, which is positive for the bonds.
So in November, we saw RBI deployed OMOs and maintained surplus liquidity. How does this affect the short-term yields and money market instruments going into December?
So the OMO supports the mid to long-term and long end of the curve, right? So it's a liquidity measure. It definitely eases liquidity into the market. However, the short run of the curve is more concerned about whether the RBI is going to stop BRRR auctions, which is going to help the overnight rates gravitating towards 5% and therefore translating into the short end of the curve.
Post GST reforms and strong tax collections in November, how do you see fiscal stability supporting debt markets in December?
See, this tax buoyancy was expected because of the GST cut and the impact after the cut was made effective. However, we have to see the trend continuing. It normally is expected that these kind of measures will translate into better tax numbers because of volume growth and so on. We have to wait and watch for some trend to emerge, which is expected. However, this is likely to have a positive impact on inflation, which is going to be a positive from an overall macro story. And as far as fiscal stability is concerned, as I said, it is likely to have an impact on the volumes, and therefore it is definitely going to add to the tax numbers as well.
So, given November's mix of stable yields, global uncertainty, and RBI's accommodative stance, what would be your suggestion to the investors? Should they stick to high quality accrual, add duration, or should they explore dynamic bond funds as well?
Well, thank you for the question. So, yield curve is fairly steep, which means the front end of the curve is somewhat discounting some kind of easy measures coming, while the longer end of the curve is not discounting anything happening, and in fact, it is discounting some kind of liquidity withdrawal or rate tightening measure sooner, right? So if as the macros are indicating, there is a possibility of the rate easy measures coming in. If not, the similar situation is likely to continue in a prolonged fashion for a foreseeable future, very long period of time. So given this entire story, the curve is likely to move either like this, deep parallel move, or it may just tilt little flatter. So which calls for a barbell kind of strategy, which is a safer, some on the long, some on the short, or you can be somewhere positioned on the long end of the curve, which is going to take care of your accruals. And at the same time, if the curve flattens because of OMOs, rate cuts, and so on, you are likely to get benefited. So overall, one answer, a dynamic bond fund is definitely an answer. But depending on your risk appetite, you can take your bet.
Thank you so much, sir, for joining us and sharing your insights on the evolving debt market landscape.
Thank you.
So this is all for today. We hope you like this video and we hope this discussion helps our investors navigate December with clarity and confidence. For more such videos, stay tuned to Kotak Mutual Fund.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.